Hey guys, Zaman
and Christina
from Our Rich Journey. We are so excited to be talking to you guys about GameStop, Reddit, and Robinhood. Because what has taken place this week is what my mom would call a teachable moment. And if you are pursuing financial independence and retiring early through investing in the stock market, there are some major lessons to be learned. And so on today's video, what we want to do is give you guys food for thought, and we think it's actionable food for thought to help you on your journey towards financial independence and retiring early by investing in the stock market.
So in this video, we are gonna unpack GameStop. We are gonna talk about how that stock shot up so quickly and the role that Reddit and Robinhood played with that. And we're also gonna talk about the lessons learned from just last week and what we saw happening with GameStop. So if you are new to our channel is all about making money, saving money, and investing money on the road to financial independence. Amana and I were pursuing financial independence for 8 years. We reached our goal. We quit our jobs as federal government employees and we retired. So if you're interested in learning more about saving money, making money, and investing money, make sure you subscribe to our channel. So let's start off by talking about what happened with GameStop in this past week, and it all begins with a Reddit group called wallstreetbets that has more than 6.8 million members in the group. So certain members of this group started this thread where they started talking about GameStop and the idea that they thought that GameStop was undervalued. Well, sometime after that, certain hedge funds decided that they were going to short GameStop's stock. So the idea behind short selling is you are basically betting against a company. You feel that it's overvalued and that the stock price is going to drop over a specified period of time. And when that happens, you can see significant returns because of it. And short selling is a multi-billion-dollar industry. But one thing to keep in mind about short selling is that it's typically done by very savvy investors or very savvy fund managers.
So this brings us back to wallstreetbets and the 6 million people that make up that Reddit group. You see, that Reddit group is made up of individual investors. And when these folks got together and said they want to go counter to hedge funds, they want to stick it to the hedge funds, it had a lot of momentum. You see, 6 million people all concentrating their effort on one individual stock, that can make a huge difference.
So the wallstreetbets Reddit group versus these massive hedge fund managers has been referred to as the modern day David versus Goliath story. We have the little people versus these big corporations or these big people with all of the money. And that is what is happening with GameStop now. The people in this Reddit group have formed this concentrated effort to drive up the stock price of GameStop in order to hurt these hedge funds. Now, we have been seeing this throughout the month of January, but we have been seeing this really concentrated effort and the effects of that even more in this past week. So this month alone, if you look at GameStop's price, it went from a low of $17.90 per share at the beginning of January up to $396.51 on January 28th. It went back down a little bit the next day to $328.24.
So those are astronomical returns, more than 1,800% just in January. This does not happen often, and so it is the reason why we are seeing so much attention taking place this week. I mean, the Reddit group doing something like this, it probably has never been done before, but with the power of social media, the news cycle picking it up, there's no wonder why it has gotten so much attention and other people have begun to pile onto this, which has led us to the point that we're at right now. You see, Christina and I want to talk about 5 lessons learned that you can take away from what has happened this week.
And the first lesson is that market sentiment matters. It can drive the price of a stock up or down, and it can do it over a very short period of time. Now, this is very important to understand because if you are investing in an individual stock, you really have to understand potentially why that price is fluctuating. And if it's based off of market sentiment, you may respond one way with your investments versus if it's based off of the fundamentals behind the company, you may respond in a different way.
And in today's day and age, an investor that invests in individual stocks must keep track of the market sentiment surrounding their stocks, especially with how social media has the ability to influence market sentiment. I mean, social media will make things go viral.
And if there's one thing that most people can agree to when they're talking about these viral moments, is that they are typically surpassed by a new and better viral moment. They are not long lasting. So when you are investing, you really have to be aware of how your investments are impacted by market sentiment and the overall attitude that people have about a particular stock.
And there's one thing that you should be absolutely clear about when it comes to sentiment. Sentiment is not always based off of the fundamentals of an investment. And this brings us to our next lesson learned. You must understand the fundamentals of any company that you invest in.
Now, when we talk about fundamentals, we're talking about the information that you can gather about a company's financial well-being. So this can consist of the company's profitability, the company's revenue, assets, liability, and growth potential. Now, for long-term investors, they are focused on the fundamentals of a company when they are interested in investing in a particular stock. With GameStop, the fundamentals do not match the stock price at this current moment. So right now, GameStop's current market value is over $20 billion, although they've closed hundreds of GameStop stores. GameStop is also worth more than 65 times its book value. So the fundamentals sort of go out the door when you're looking at GameStop right now.
Now, we have seen this situation many times before. I think one of the most memorable is the dot-com bubble, because there were many stocks like GameStop right now, where you have this momentum or frenzy pushing the stock value up. The story is not necessarily the same, but the frenzy is right on cue, where you're pushing a stock way beyond the fundamentals. And what happened with the dot-com bubble? Finally, the fundamentals came to light and those dot-com bubbles burst.
So the lesson here is that if you get caught up in these types of frenzies, make sure that you pause. Make sure that you begin to do thorough research, looking at the fundamentals of each company that you're investing in. And this is especially true if you are that long-term investor looking for that long-term growth and pursuing financial independence to retire early.
And this brings us to our third lesson learned. Because if you are a long-term investor, the brokerage company you pick matters. And we've seen what took place this week with Robinhood, and we could not help but think this is a disaster for anyone that has a significant amount of wealth with Robinhood. Christina and I think it's no secret, we have the majority of our wealth with Vanguard. And so we could not imagine having millions of dollars with Robinhood and all of a sudden they tell us that we cannot trade our securities. This would be disastrous. And if you are a long-term investor, it really matters where you keep your wealth.
So if you're unfamiliar with what was happening with Robinhood, they were being bombarded by all of these trades of GameStop. And in response to that, they ended up having to suspend trades. After that, they then responded by limiting the number of trades among 50 different stocks, one of them being GameStop. So what they did was they limited accessibility to the market.
So this can be a very dangerous situation, because if you are investing with a company that limits your accessibility and in fact surprises you with that limitation, it puts you at a disadvantage to other investors that are investing with brokerages that do allow them that accessibility. This is why picking the right brokerage firm to invest with is so important.
Now for us, like Aman said, the majority of our money is with Vanguard. But when we were deciding, we were really looking at the big three to invest our money with. That was Vanguard, Fidelity, and Schwab. You can invest with whatever brokerage company that you want to, but the reason why we ultimately decided to put the majority of our money in Vanguard is because we were looking at specific factors and we were comparing different brokerage companies along those factors. So we were looking at customer service, track record, fees, reliability, security, the history of the brokerage firm, products and services, and accessibility to investments. So whatever brokerage firm that you decide to invest in, make sure that you're investing in the right one. And our next lesson is be careful showing up late. Now, a lot of times we see these headline grabbers in the news about stocks soaring and tons of people want to get in at that point. But the truth of the matter is, by the time the media picks it up, it may be towards the end of its run. Now, we don't know that with GameStop. We don't know if it's going to continue to rise or when it will crash, if it will crash. So this may be a lesson to learn in the future. The idea is that it is very likely that GameStop will crash. And if that's the case, you really need to be careful.
But this also brings up a disturbing observation that we often see, and it is people constantly chasing the quick dollar. You see, if you were to just focus on investing in a fundamental fashion, there are opportunities right in front of you. But for the people that are continuously chasing these momentum or these frenzy type of investments, you are showing up to the party late 9 times out of 10. If you took that same energy and instead developed a consistent investment plan, we think you would be a lot more successful. And this brings us to our last lesson. It has been an exciting week to watch the stock market. I mean, me and Christina have been sitting over here with our popcorn, listening to all of the commentators go on and on about the Reddit rebellion, about Robinhood, about all of this stuff that probably has your blood pressure boiling if you are involved in this situation. But see, me and Christina also are sitting back watching all this craziness, relaxed, because we have an investment plan in place that is boring. Now, the returns in our boring plan have been astronomical because we have consistently done the same thing over a long period of time. That is why we call ourselves long-term investors. But we also have the right to call ourselves boring investors. And when you are a boring investor, you take a lot of stress out of situations like this. You're not concerned with these run-ups and run-downs because your plan is already working in the background.
So with boring investments, the idea is to really eliminate that emotional attachment you have with watching the stock market rise and crash or individual stocks rise and crash. The idea is to put your investments on autopilot and keep it boring.
And so we wanted to make this video because it presents a great opportunity to learn a lot from this situation. I mean, there are going to be many more situations like that because, to be honest with you, this is par for the course. This is what investing in the stock market is like. There's always a story to tell behind each and every stock. And so if you like this video, please, as usual, give it a thumbs up, share it with a friend, and join the journey.